Hey, what's up, Market Moose? Mike from the Moose on the Loose. Forgive my voice. Big soccer tournament this weekend. So we had a lot of fun, and I coached those kids. Super proud of them. And of course, the voice is paying the price for it. Today I want to talk about the one of the hardest thing as an investor to do as to sell. We have this feeling that we should hold or stocks forever, right? It totally makes sense. I mean, Warren Buffett's of this world are always telling us, like, you do the hard work when you buy. This is when you make the money, and then you hold on forever, like diamond hands. You're going to benefit from those profits down the road as the company compound. But here's the thing. Sometimes we have to sell. And tracing that line is not easy. We fear of being wrong. We sometimes don't want to lose money, right? So especially when we have a loser in our portfolio, we're just like, yeah, we're gonna hold on until it recovers. I often hear that from investors, like, yeah, that's okay. The business is fine. It's going to rebound. I'm holding. This is part of my strategy, and it's not totally wrong either, right? And there's also another saying is, as long as you don't sell, you don't obviously lose money, which is completely wrong, right? You can ask that to people that invested in BlackBerry or in Nortel or in Bombardier a while ago. They keep on losing money. I mean, it's on paper, but I mean, it's still there. So it hurts more than you think for not selling, keeping those stocks that should not belong up in your portfolio. And I'm not just talking about loser here. I'm talking about all the companies that should not be in your portfolio at one point or another. So first, it hurts more than you think. There's an opportunity cost. The opportunity cost is kind of like hard to calculate because you don't know exactly what you would have done with the money. But if you keep a loser or a company that is not a good fit for your portfolio for a long while, you obviously made that choice of keeping that stock instead of investing it in something that would make a better fit in your portfolio, maybe in terms of strategy, in terms of diversification, but also align a little bit more with your core beliefs. And maybe that stock would have done a lot better as well. So that's the opportunity cost. You may double down on being wrong twice in a row as well. So that's also a possibility. And I get why it increases that doubt and that dilemma of, like, should I hold or should I sell right away? The other thing though is, if you're holding a company with bad metrics that are not performing, you see the business is struggling, it's having a hard time, facing a lot of competition, having a hard time to pull out new products, doesn't show any signs of growth, well, then the other thing that could happen is obviously a dividend cut. And when the dividend cut happens, most of the time the market saw it coming. What it means is, for several months, you'll see the company struggling, the stock price declining, and eventually you get the dividend cut. But once you get hit by that, it's already too late to come back and then sell the stock and then try to recover your money, because you lost so much on the stock price and now you're losing on the income as well. That brings me to the break-even fairy tale. You know that if a stock loses 10%, you only need 11% to come back, which doesn't make it that hard, right? But the more you lose, the more the total return that you need to get to just recover your money is crazy. And if the stock loses 50%, like BCE roughly lost 50%, now you need that stock performance to double, to go up by 100% just to break even. So you have to ask yourself, what's the conditions? What's the potential environment? What's going to happen to that company for its stock to double in value? Like, how many companies that you have in your portfolio that are struggling and are actually doubling in value? It's usually the opposite, right? You're going to see that with companies that are going sky high, lots of double-digit growth metrics like revenue, earnings per share, dividend, cash flow from operation. When all of that grows double-digit, yes, you have a chance to double the money that you have invested. On the other way around, it's a lot harder. And most importantly, I think this one, we often don't discuss it, but it's a bad reminder in your portfolio. When you don't sell, you keep a doubt. Even if it's a good company, like in terms of performance, even if you're making money, you have that doubt of like, what should I do with this one? And every time you ask yourself that question, you just increase your level of uncertainty. You decrease your level of conviction. You increase your doubt. You increases your dilemmas. And if it's a loser, it's even worse because it's a reminder that you made a bad decision. But you try to toss it around, but every time you open your brokerage account, you see that red line, not making it easier. And then you could start losing faith in your strategy and starting to ask yourself, well, maybe the way I invest is not the right one. And that sucks, right? Because you put a lot of time, hard work into crafting this strategy, crafting the way you invest, having an investment process. And by the way, if you don't have if you're not able to explain your strategy and your investment process in simple words, you probably don't have one, and you're probably just following the news or following like YouTube's or podcast channels to like get stuck ideas. That is not having a strategy, and you have to go back on the drawing board very quickly. So how can we get rid of those stocks that don't belong in our portfolio in a faster way, that we quickly move on and we don't get stuck in that paralysis by analysis? So here are a few rules, here are a few tricks that I'm using. The first one is, of course, having clear investment rules. That makes it easy. For example, I have the investment rules of like whenever I buy a stock, I write down the investment thesis. And then when the investment thesis, like those are like all the good reasons why I like that company and why I want in my portfolio, when they're not true anymore, I just sell because company changes. We changes as human, right? So company changes as well. The environment changes. The economy changes. Example, Andrew Peller. I bought it a while ago in 2016 or 2017. Can't remember. 2017. Based on the fact that it was a dominant wine distributors in Canada and most importantly, growing by acquisition. They stopped doing that in 2019, and then eventually I sold it because the company, the one that I found it very interesting is they were able to acquire smaller competitors and benefit from their wide distribution network to make more money. Well, then it's not happening anymore, out of my portfolio. On this one, I lost money. So yeah, it's a good example of like getting rid of the loser and moving on. But I also have an example of a company where I made a lot of money and still moved on. Enbridge. I bought Enbridge towards the end of 2017 based on the fact that, yes, there was price weaknesses because there were a lot of uncertainties around the company and its pipeline project. And also because back then, the company was offering a 10% dividend increase every single year. That's crazy, right? So strong dividend grower, lots of cash flow generation. And on top of that, price weakness followed by pushed by a bad narrative. Got rid of Enbridge in 2022, when interest rates were higher and the company stopped being a high single-digit to double-digit dividend grower. So now the company was stable. I made my money. I made over 50% profit on this one. But unfortunately, because of this situation, because where they were with their debt level and the interest rates, they started to pay a 3%. They started to offer a 3% dividend increase. Not bad. Great company. I'm not telling you to sell if you have it, not financial advice. But for me, I'm a dividend grower. I focus on dividend growth, high growth, which is not the case anymore with Enbridge. So I sold, made money. Got another example. Of course, if you have like dividend cuts, that's a clear sell. I sell and I move on. And that's one super easy one to follow. And the one that is a bit more tricky is when you have your set of metrics. My favorite metrics are the dividend triangle. So the revenue growth, earnings growth, dividend growth, when they don't match my investment thesis. So a good example would be Magna International. Was very excited about Magna International, one of the largest car auto part maker. I made an episode on that not too long ago. Still have this strong thesis. I mean, they inked a bunch of deals with EV vehicles as well. They are very good business, but the dividend triangle keeps on being shaky. It's hard for them to consistently maintain their margin. So the earnings per share, sometimes it goes up, sometimes it goes down, sometimes it struggles. I didn't like that. I saw the dividends slowing down and eventually I decided to sell. Didn't lose much money, didn't make much money. That was pretty much a neutral trade. But the point was not confident in that stock anymore. Another trick I have for you is to get excited about a new stock. It's easier to sell something that does not fit your strategy if you're excited about something else after. For a long time, I wanted to add Stentec in my portfolio, but I was fully invested. That's like one of the cons of being fully invested. You cannot add more capital to your portfolio. It's already invested in the stocks. So then when I found a company that did not fit my portfolio anymore, I was super excited to jump into Stentec. If you want more trick like this, I will have a webinar to help you get rid of paralysis by analysis on September 18th. You can subscribe to moosemarkets.com/webinar. The webinar is 100% free. You're going to have like a 1-hour Q&A after the presentation on top of that. So it's all good for you. moosemarkets.com/webinar. So, all right, guys, tomorrow I'm probably going to be a bit late with my podcast because we are going to look at Couche-Tard's results. They are reporting this at the end of today. So I don't know if I'll have time, but it will come out tomorrow morning for sure. Until then, don't forget to stay invested.